evening, everybody. Now, tonight I'm going to talk to you about the monetary system. Now, this is not something many people think a lot about or know very much about, but it's very important because it affects everything to do with money. The money in your pocket, the value of the money in your pocket, your interaction with the banks, the economy, a whole host of things. So you need to know about it. And if you know about it, then you can protect yourself against some of the things I'm going to tell you about tonight. So what is the, can this come off? Yeah. What is the monetary system? It's a global network of institutions that are responsible for the creation and distribution of money and the rules, regulations, and policies that pertain to the same. Now, it's a pyramidal system. And the apex of the system are what I call the Big Four. The Big Four are the Bank of International Settlements, the IMF, the World Bank, and the Financial Stability Board. Now, they make all of the rules, regulations, and policies that filter down to the central banks across the world. And the central banks use these as their guidelines, and they regulate the commercial banks, the investment banks, the offshore banks, who act as a financial intermediary with the rest of the economy. That is, the governments, the corporations, and all of us sitting here right now. Now, the Bank of International Settlements is at the apex of it all. They're located in Basel in Switzerland. Now, you see I got an asterisk by the BRIC Bank and the Asian Development Bank. That's for a reason. Those banks represent China, India, Brazil, and Russia. And they're not happy with the fact that at the IMF and the World Bank, they don't have proportionate representation, voting proportionate to the size of their economies. So they said, you know what? We can form our own banks. And those banks actually are capitalized with more money than the IMF and the World Bank put together. And the Chinese One Road, One Belt initiative is actually being financed by the Asian Development Bank. Now, the BIS, which I say is located in Switzerland, they're really the key player. All these committees are there. The Basel Committee on Banking Supervision, which is responsible for Basel 1, 2, and 3 accords the banks utilize. The Committee on Global Financial Systems, the Committee on Payment Systems, Economic Consultative Committee, and the G7 and G20 Ministers of Finance and heads of central banks meet there on a regular basis, and they determine what happens in the rest of the world to you and me and everybody else. Now, here's something. You have 189 people who rotate between the BIS, the IMF, the World Bank, and the Financial Stability Board, who form all of the subcommittees, and they determine the plight of 7.5 billion people in the world. Now, these are policies. These aren't laws. They're policies. But they have the force of the law because they're the guidelines used by the central banks and by governments. But there's a bit of what I call selective rule bias. We have, for example, very stringent anti-money laundering laws, anti-financial terrorist financing laws. But guess what? In 2007, the financial crisis occurred because of primarily derivatives and because the banks were too big, too consolidated, too much systemic risk. Now, in 2018, as we sit here today, there's $1 quadrillion worth of derivatives out there. The banks are even more consolidated than they were before, bigger than they were before. So the risk is still there. But these big four have done nothing about it. Why? Because the banks make tons of money from these derivatives. The next thing is that immunity. If you work at the BIS, you are immune to Swiss law. You have diplomatic immunity. You pay no taxes on your income. And the corporation itself, BIS, pays no taxes. They make approximately, well, the figures from 2016, they make $100 million every month. And they actually are the bank of the central banks. And they invest the monies, the public monies in the central banks, go to the BAS, and they invest it for the central banks. So they're making money off you and me and pay no taxes. Yet, they want to determine the laws about all those of us who pay taxes around the world. Now, what happens when you disagree with these guys? Well, they cut you off from the payment systems. And you can't transact with the rest of the world. That's the big sword or stick that they use. So what's the role of the central banks? Well, most of you probably know this, but for those of you who don't, they issue currency, they're the bank of the government, they control the money supply, and I'm going to be talking a lot more about that in a few minutes. Exchange control, they're in charge of the reserves, they have a clearinghouse function, and they collect and publish data, some of which I'm going to use tonight. Now, how is money created? Well, that comes down to the retail banking sector. And this is a very interesting phenomena that a lot of people don't understand. And it's called a fractional reserve system. So, let's say Mr. Coulson here puts $100 in CIBC or Scotiabank today as a deposit. If the reserve ratio of the banks is, say, 10 to 1, they can lend out $1,000 based on his $100. Now that money has come from thin air, because he didn't put $1,000 in there, he put in $100 in there, okay? So the higher the reserve ratio, the more money that can be lent out. Now the problem is, if we all put deposits in CIBC, and for some reason we lose faith in the banking system, we say, you know what, we want to get our money now, and we go to CIBC, the money wouldn't be there, right? And that's how central banks came along. They're the lender of last resort. So let's start now and talk about some of the peculiarities, shall we say, or the conundrums associated with the retail banking system. And I could talk to you about this for the next 5 hours, but I'm only going to talk about two things as far as the retail banks are concerned, because we have more important fish to fry. When you go to the bank, and I can tell you, before I wrote my second book, I did a little bit of research. I went to 5 banks in the Bahamas, and I said I wanted to borrow $20,000 to buy a car. And they told me, yes, sir, 7% interest will charge you. But when you actually put the figures in your HP12 calculator, and you calculate it out, it's actually 14%. Now, why can they do that? Why can they trick you? Because we have no truth in lending laws. And we're supposed to be a big-time financial center, and we have no truth in lending laws. Also, in most countries, if you have, as a corporation, more than 14% market share, then you're considered to be a monopolist. And in the Bahamas, there are many banks that have more than 14% share, but we have no anti-competitive laws. So when you go to the bank and they say, we're going to charge you 14% or 7% of your car loan, and you say, man, that's too much, they say, well, carry you know what up, right? Because if you go somewhere else, they can say the same doggone thing to you, right? Okay? So we're all familiar with that. So we need antitrust laws. Now, how does the central bank control the money supply? They have 4 basic methods. The first one is the one that's used most currently in the Bahamas, moral suasion. So the governor will call up, or one of his people call up the head of Scotia and say, listen, man, we need to cut back on this lending. So they cut back on the lending. Or you'll say, we need to increase the lending. So they increase the lending. The reserve ratio is another way, and I just described that to you before. Higher the reserve ratio, the more money out there, lower the less. Interest rates. Well, the central bank can raise or lower the central bank interest rates, and the banks take they determine their rates based on the central bank rate. So the higher the rates, obviously, fewer people borrow. The lower the rates, more people borrow. Government securities. So the central bank holds government securities, and so do the banks. So if the central bank purchases government securities, like Treasury bills and bonds from the government, then they put money into the banking sector, which will put up the money supply, potentially, and the reverse if they sell. Okay? So those are the 4 basic ways. Now, this money supply is a very important thing because it affects the economic growth. There's a guy called Nathan Rothschild, probably the greatest banker ever. There were 5 Rothschild brothers, by the way. He was the one who was positioned or located in England. And so what did he say? He said, I care not what puppet is placed on the throne of England to rule the empire on which the sun never sets. The man who controls the British money supply controls the British Empire, and I control the British money supply. 1815. The same is still true today. Now, when Bush, I forget which Bush it was attended the swearing in of Ben Bernanke, former head of the Federal Reserve of the United States, which is their central bank, right? He said, this man is the second most important man in the United States. And he was right, because he controls the money supply of the United States. So let's look at how this money supply situation works. This is a very simple economics equation. You probably all know it. If you don't know it, you need to become familiar with it, because if you understand this, you understand all you need to know about the money supply. Okay? So the money supply times the velocity of money equals the price of goods and services times the quantity of goods and services. In other words, the money supply equals GDP. The price is inflation, and this here is real GDP, which is equivalent to this here. So if you increase the velocity of money, now what's the velocity of money? If I caught a taxi to come here, and I paid the taxi driver some money, and he paid his housekeeper, and his housekeeper went to the food store to buy something, that's a velocity of 3, right? Okay, so the velocity of money is determined by a couple of things. One is the amount of debt in the economy, the amount of deleveraging in the economy, that's people trying to get out of debt, and animal spirits. If we feel good, we spend money. If we don't feel good, we don't spend money, right? So that determines the velocity. So if the velocity goes up, the money supply stays the same, then GDP goes up. Now, if the money supply goes up, and if velocity stays the same or doesn't go down, then GDP will also go up. If the money supply goes down, GDP goes down. Now, what happens if the velocity stays the same, the money supply goes up, and the quantity of goods and services produced stays the same? You have inflation, right? But if the money supply goes down and the quantity of goods stays the same, you have deflation. Okay. Professor Forbes taught you that, right? Okay. Yeah, all right, good. Just making sure he's doing his job. Okay, now, so what are the guidelines that central banks use to determine what the money supply is, what the monetary policy is? Unemployment, in the United States, the unemployment target is 4.5 to 5%. Inflation is 2%. Now, you know why they always want to have a little bit of inflation? It's very interesting, because you can tax inflation, but you can't tax deflation. If your income goes up, they can tax that. But if it goes down, they can't tax that. That's why they want inflation, okay? But also, in the last several years, in fact, last 10 years, the stock market has been their guideline. And the reason for that is because 60% of all taxes paid in the United States come from stock market gains. So if you put the interest rates up, the value of stocks go down, less capital gains, less taxes. So the Federal Reserve right now is being guided to a certain extent by the stock market. In the Bahamas, it's not so much this, it's not so much that, because we have high levels of structural unemployment in the Bahamas. Consumer price inflation is pretty low, but we have core inflation, which is a much more dangerous situation than consumer price inflation. But they're guided by the peg. Now, why is this? How does this work? Well, during a recession, normally what happens is the central bank will lower interest rates to get the economy going, right? Low interest rates, people borrow more money, spend more money, more economic activity, right? During a boom, they increase interest rates. Everywhere in the world, this is exactly what happened, except where? In the Bahamas. Okay. Now, how do you determine what the right interest rate is? Well, you know, there's an Austrian economist called Wechsel, and not many economists know about him, it seems, but he was a very smart guy, and I read his work, and what he said is this: there's a relationship between the cost of capital and the return on capital. So let's say, for example, my friend Brian Jones here, and by the way, Brian Jones is the smartest guy in cryptocurrencies in the Bahamas. Anything you want to know about cryptocurrencies, you ask this young man. He was the one that came up with the smart fund concept that's used by a lot of the offshore banks here today. He's a wizard. Anyway, if Brian wants to borrow $100 from the bank and to do a project, okay? And let's say the bank's charging him 8.75% interest. That means every year Brian has to pay back to the bank $8.75, right? But if the economy is bad and his project's not making any money, he may only be making like 50 cents on his $100. So guess what? Brian's going to go out of business, right? Was the same in the Bahamian economy. The banks on average charge 8.75% interest on loans, okay? But the economy over the last 10 years, work it out, you can do the math yourself, has been 0.59%. That's economic growth, real economic growth. That's why so many businesses have closed down, so many people lost their homes, so many people out of jobs, because there's too big a spread between the cost of capital and the return on capital. The central bank rate presently is 4.75%. It needs to come down. But they're concerned, they're angst, right? And angst is a German word for fear. Is that if they lowered interest rates, people borrow more, spend more, import more. But guess what? The economy goes up, right? And government's income goes up because government gets money from imports, right? But the central bank's concerned because of the drain on the reserves. Okay, so they have a fear of devaluation. Now, the IMF, we're a member 4 IMF member. So here we go again, the big 4 influencing us, right? And as a member, as part of that membership, we have to retain $750 million in reserves in the central bank in order to retain the parity of the Bahamian dollar to the US dollar. So their concern is if the reserves go down, we may have to devalue. So that's the paradox, is maintaining the peg reduces economic activity. It's a paradox. So the central bank's position is determined by the level of US dollar reserves and the profitability and sustainability of the Bahamian financial institutions. Now that's a reasonable position, given their mandate to control exchange control, to manage exchange control and to ensure the stability of the banks. But the fact of the matter is it causes economic stagnation and prolonged economic recovery. So we do have to decrease these interest rates. There's no doubt in my mind they have to come down. And we have to find a way to get more US dollars into the economy. These are 2 crucial points. So if we reduce interest rates from 4.75% to 2%, that's the central bank rate, the bank rates have to come down as well. Although there's usually a lag of about 3 months. They say it takes them 3 months to change the computer system, right? Okay. You know what that's all about, right? Okay. So we have about $7 billion in public debt. If the rates come down to 2%, then the government would pay $140 million less in interest expense every year. The private sector has $6 billion in debt. You'd pay $165 million less in your repayments to the bank for your car loan, your home loan, your overdraft, whatever. So that money, $300 million now, would be spent in the economy. And that would boost economic growth. In the banks in the Bahamas today, there's almost $1.5 to $2 billion in cash sitting there that's trapped because they say people don't qualify for the loan, or people have so much debt they don't even want to go and borrow the money, or they come with a project and they say, well, we're only going to finance a car loan, not Brian, who wants to do something that's productive, could actually increase economic activity. So we have a liquidity trap. But if you bring the interest rates down, then guess what? The money goes into the economy, right? Because the money be lent out. So let's look at now how to get more US dollars into the system. So let's look first of all at what's happening right now as we speak. Their exports are mainly tourism, pharmaceuticals, plastics, and seafood. but don't amount to that much. So money comes in from the sale of those goods outside. We get proceeds from foreign currency lending. So the government borrows in foreign currency. Those monies come into the country. Direct foreign investors, when they come in, they often will bring in US dollars into the economy, although not as many as you think. Of the $4 billion with Bahama, really only about 400 million actually came into the economy. And that's the fallacy, actually, of direct foreign investment. It's not what you think it is. Sales of domestic assets. If we sell, say, like we sold BTC to Cable and Wireless, so they gave us US dollars for that. Not enough, mind you, but they gave us some. Inbound remittances. So I'm here, and Dick Coulson's in wherever he is in America, and I said, Dick, I need some money, so he sends me a remittance, and I get that. So all those monies coming in are inbound remittances. But then they're dirty dollars. And we'll get to dirty dollars in a minute. Dirty dollars, what? Very important dirty dollars. Okay. So, outflows, trade. We have to basically import everything that we use. So a lot of US dollars go out for that. Repayment of foreign currency debt. So when you borrow money from abroad, you got to pay it back. Repatriation on portfolio investments. So when resorts and the banks or whatever make big money and they want to send it back to the head office in Canada or United States or wherever, that money leaves. And there's capital flight. So Brian may say, you know what? Things don't look too good in the Bahamas. I'm going to take my money out. So he changes his money to US and he takes it out, which everybody should be entitled to do, by the way. Okay. So we need new sources of US dollars. Now, where are they going to come from? And I've been thinking long and hard about this for many, 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 many years. And some of these are my ideas, some of these are ideas of friends like Brian, but collectively we've come up with some new things. The bottom line is we need to start producing more goods and services that we can export. Okay? Building a new apartment building is not going to do it. Creating a new app that people buy from abroad will do it. We need to have domestic-based direct foreign investor treasuries here. So when Dick is in New York, say he's a tourist, and he wants to book a vacation to the Bahamas, he uses his credit card, okay? And I think he has a platinum card or black card, right, Dick? And when he uses his black card, you can't hear me, but that's okay. When he uses platinum card, that money doesn't enter the Bahamas. It stays in the system in the United States, right? But if Atlantis and Bahama were made to have the treasuries here, the money would come into the Bahamas. Now, these guys, by the way, have received $10 billion over the last 10 years in subsidies, concessions, land grants, which is a direct transfer of wealth from you and me to them with no equity in return. So all these agreements have been made to give away your money, your property, your concessions, your future. Okay? So if they're made to have it here, that would be a small compensation for the $10 billion, right? Have your treasury right here in the Bahamas. Direct foreign investments, payment of domestic salaries and bills. So let the hotels, let the offshore investors pay you and me in US dollars and pay the bills in US dollars. Next one is domestic ownership of tourism financial services. In 2014, we took in about $3.3 billion from tourism and financial services. But because 90% of those services are owned by foreigners, not Bahamians, the money didn't come in. Okay? So we need to encourage that. Now I'm not saying take away what they have. You can't take it away. That wouldn't be fair. But any future projects now, you've got to encourage some local participation and equity. Next thing. In Bermuda, Bermudians can invest their monies wherever they want to in the world. Wherever they see a good investment, they can invest. No problem. You have to go to the central bank? None of that nonsense. And they get in dividends, rents, and interest payments coming in from their investments abroad more money than Bermuda gets from tourism. Okay? That's what we need to do here. To take your money out of this country, you got to pay a premium. To bring it back, you got to pay a premium. Ridiculous. Foreign purchases of Bahamian dollar debt. let Americans, let Europeans buy our bonds. Why not? They take the currency risk, okay? But they get a higher yield than what they're getting in Europe, United States right now. Let them buy the bonds. That's money coming in. Now, we need to have a Bahamian-based credit debit mobile payment system. Now, let's talk about this for a second. When you use your Visa card, or American Express, Diners card, MasterCard, whatever, there's a merchant fee, right? And there's about $2 billion worth of purchases made with credit cards in the Bahamas every year. So the merchant fee is anywhere between 1.75% if you're John Bull, up to 6% if you're Chicken Shack in Long Island, okay? That money goes three ways. It goes to the processor, who's usually a foreign entity, always a foreign entity actually. It goes to the brand, Visa, MasterCard, and it goes to the bank. In our case, most of the banks are foreign owned. Now I'm not knocking anything that's foreign, this is just the facts, okay? But what if we had our own brand, say called it Bahama Pay, and it ran on Bahamian lines, all right? The money would stay here. There'd be less money going out in US dollars to pay for your credit card uses abroad. And we could hook up to Cirrus, so you could use that same card in the United States or America, wherever, and we would still get a good portion of money coming back into the Bahamas. Now this last one here, the UN Bahamian currency swap for oil and food. I'm coming back to that one. But remember this one. This is a very important one here. Okay, now another reason why we have a shortage of US dollars is based on this whole balance of payment system. So the balance of payments, you guys are familiar with that, right? Balance of payments per country? Okay. So you have the current account, which deals with all the money coming in and out due to exports and imports, right? So 2014, this is right from the central bank report now, okay? 2014, we were $1.3 billion short. $1.3 billion went out more than came in. In the capital account, which is monies that come from US borrowings, okay, was 300 million. So the current account usually has to equal the capital account. If it doesn't, as it did in this case, it was $1 billion short, it then goes to reserves of the central bank. So if you have a deficit, the central bank then has to come up with those extra dollars. Now during this year 2014, by the way, same 215, 216, 217, same thing, the central bank at that time only had $800 million in it. So they would have had to have borrowed another 200 million in order to service our US dollar obligations. So effectively, the Bahamian dollar devalued in 2014. However, dirty money. I still come back to dirty money, right? Errors and admissions speaks to money that came in unregulated. So what are the sources of dirty money? Drugs, gun smuggling, human trafficking, and gaming industry. Right? You got it. Now, I'm not going to go into all that tonight because that's a different story. But if it hadn't been for the underground of money, we would have devalued. So what are the implications? If you run a chronic current account deficit every year, you are going to go into more debt as the public and as the private sector, because it means we're consuming more than we're producing. That's like my friend here eating more ice cream every week than his mommy can afford to pay for. She's got to borrow money to buy his ice cream, right? More and more debt every year. So there's a shortage of legitimate overground money, should we call, in the Bahamian economy, about $1 billion every year. And the central bank, as I said, had this shortage. So, all right, so we need to get more US dollars in. That's the point, okay? I think some of the things I've mentioned could do the trick for us. We just got to do it. Now, let's talk about currency systems. There's been a lot of talk recently with the central bank relaxing exchange controls. Right? Right? Have you heard about it? They have reduced it a little bit, okay? They've reduced the requirements, okay? Eased up a little bit, which is good. It's a step in the right direction. No matter what system you go to, whether it's floating, dollarization, dual currency system, we use US and Bahamian dollars, all systems still require that you have sufficient US dollars in the system. And we already established we got a dollar deficiency. So let's go through these bit by bit. I don't know if Giorgio's here tonight. No, he's not. But anyway, Giorgio is a member of the Nassau Institute. And last year we spent several nights and a lot of talking, working out how this thing could work. Because you can't look this stuff up. You have to figure it out for yourself what would happen. But anyway, he was very helpful to me. So if you have a dollarized system, it means that no more use of the Bahamian dollar, only US dollars. The central bank would still regulate the banks, but they wouldn't be in charge of monetary policy. That would be the monetary policy of the United States, or the Federal Reserve, right? There'd be no printing of money, therefore no signage. So what's signage? So when the central bank has these US dollars in reserves, what they do is they buy treasury bills and bonds, and they make money on that. That's the signage, okay? And signage can be up to 2% of your GDP in a country at any given time. So it's a significant amount of money. Public debt, that is government's debt, would now be based on market prices, not on the central bank setting the rate, which they do right now. And they set that rate based on what the central bank rate is. So for the 15-year bond is equal to the central bank rate, which is 4.75%. Every year after that, they add on 1/8 of a percent. Every year less than that, they take off at 1/8 of a percent. But now, it'd be determined by the markets. So American or Bahamian say, you know what, man, if you want me to lend the government money, you got to pay me more interest, right? Because more risk. Now, but ourselves, in borrowing now, we'd borrow at US rates because it's dollars we're borrowing, okay? Be good for us, right? Really good for us. All right. So what about dual currency system? Well, in a dual currency system, the amount of US dollars or Bahamian dollars has to equal the amount of US dollars. Now, in order to have a dollarized system or a dual currency system, you have to have US dollars equal to the monetary base, which is $6 billion. I already said we're short 1 billion, right? So you find 7 billion somewhere, somehow. So in this system, the central bank will still regulate the banks, but the net inflow of US dollars to determine how many Bahamian dollars do we have. So if there's $100 million in US, you have to have $100 million in Bahamian in order for each dollar to be equal, to be on par, right? Right now, it's 20% US dollars to every $100 in the system right now. Okay. Now, the difference between the local interest rates and the US interest rates will to a certain extent determine the flow of US dollars in the country. If interest rates here are higher, more US would come in, lower, they would go out. So it'd be a balance between those things. We still have to print some money, there'd be some signage, and the cost of public and private debt would also be more market driven. Let's talk about floating currency. That is where your currency floats no matter what. That'd be a disaster for us. The reason being is that the supply dynamics are bad because we import so much and we export so little. So if we had more exports, it'd be a different story because when your currency goes down in value, you export more and that balances out your balance of trade, right? So our trade deficit would skyrocket, total debt would go up, and as the dollar depreciated, then the direct foreign investors would disappear, and Dick would take all his money out of the country, okay? So that would cause further deterioration in the value of the dollar. Now, there's a principle called balance sheet debt. You may or may not have heard about it. But balance sheet debt is this. When foreign countries borrow in US dollars, but they're earning in their local currency, if their currency goes down in value, then the principal amount they borrowed goes up, right? That's what happened in Argentina recently. That's why they had a debt crisis there. That's why the IMF had to bail them out, $50 billion. Turkey and I think one other country, I can't remember right now, Brazil, they're on the verge of the same thing happening. So any US dollars we had in borrowings, if our currency depreciated, the principal would go up. And that's the cause of a lot of sovereign debt crises, corporate debt crises, and banking debt crises, because often the banks borrow in these foreign countries in US dollars. Okay, so in this floating currency system, there'll be winners and losers. The hotels would make out like bandits. They earn in US, but they pay Bahamians in, okay? But you and I, who earn in Bahamian, we're the losers. So what happened then is, unless the hotels paid everybody in US, or they expanded and increased their payroll, so in aggregate, the amount of money you made up for the loss of value, which wouldn't happen because as capitalists, they're going to make as much money as they can, right? And that's fine. There'd be tremendous asymmetry of wealth, which there already is in the Bahamas, and social and political disruption like you wouldn't see, like crazy. Even Bahamians would get upset with that. Finally. All right. Now, let's talk about the correspondent bank issue. As you know, many of the banks have lost their correspondent banks in the United States. That means they can't do US transactions, US dollar transactions. So the Bank of the Bahamas is hanging on by the skin of its teeth. It's using Deutsche Bank right now. Many of the offshore banks have lost their correspondents. So we got a problem. And I found a way to fix that problem. Now, there's several reasons for the problem. One I don't have up here, which is one of the important ones, ostensibly anyway, is that, relatively speaking, the amount of business these guys do in the Bahamas is pretty small on the scale of things, right? But the amount of compliance and the expense of that compliance is so doggone high, they say, you know what, screw it. It's not worth our doing the business with you guys, right? Which is fair enough. But an even more ominous problem is that the OECD countries have determined, because of the high levels of debt in all these countries, high levels of debt, every single one, Japan, England, Canada, United States, the Euro region, China, every single one have total debt to GDP over 175%. That's public and private debt. When the debt gets up that level, your GDP falls off exponentially. And it's very hard to get out of that kind of debt. So they want every single tax dollar to get their hands on. And they're coming after us, all right? And they're not going to stop until they get what they want. They got the big hammer, remember, the big four, right? That's the big hammer, okay? Also, they're pissed off. And why are they pissed off? They're pissed off because in 2002, we introduced legislation to deal with people who messed up. But to date, there hasn't been a single prosecution, even though the banks have reported numerous instances where there have been people who have been involved in illicit activity. Okay? And that's another story for another day. But that's why they're angry. Also, they perceive breaches in AML. Go back to dirty money, right? They read the statements. Even though the central bank hasn't explained what I've explained to you, it's right there. Anybody in any sense can see that. Okay? So they know what's going on. So what are the solutions? We fully comply. Well, we've done that for the most part, but they're still trying to put the screws on us, right? We start prosecuting some people. That'd be good. But they work around solutions, and that's what we've come up with. I want to show you tonight. So there's three solutions. The first, a central bank clearinghouse solution. The second is a Renminbi Bahamian dollar swap. The third is a Jamaican Haitian Bahamian Treasury note swap. So let's just go through those quickly. Central bank clearinghouse. So what would happen is all the financial institutions of the Bahamas would form a private-public partnership with the Central Bank of the Bahamas. The Central Bank of the Bahamas would then have a relationship with all the banks around the world with which we do business. No corresponding banks. So central bank to central bank. Those guys trust each other. They're all in the club, right? So all transactions would go from, let's say, your financial company to the central bank, to the Federal Reserve, to the financial service provider over there, and then on to the customer. You have one tunnel. That's a great arrangement, right? Because you can see every single transaction going on, and it's easy to monitor it. All you need is 4 Swiss bankers to monitor the whole system. Wouldn't cost that much. Now, the other good thing about it is this. It's a big money maker. Think about it this way. In the offshore sector right now, there's $175 billion in assets, down from $550 billion 5-6 years ago. And that just shows you how much we've lost in offshore services, right? Now, a lot of those people who have portfolios buy treasury bills and bonds. Probably at least 30-40% of some portfolios, Brian can correct if I'm incorrect, are the purchase of treasury bills and bonds because they're supposed to be safe. They pay a little bit of interest, but your money's pretty well safe. So they think. Now, when these companies buy these treasury bills and bonds for their customers, their clients, if it's a European, it goes through Deutsche Bank. If it's an American bond, it goes through JP Morgan. And they make a big spread, right? Because they're the market maker, right? Now, in this system, the central bank would buy these bonds directly from the Bundesbank in Germany or from the Federal Reserve. So they make the profit, and so too does the private-public partnership. Now that's a lot of money, $175 billion. Some of those are shares, and those shares would also make money on the transactions with the shares. Okay, so now let's look at the Jamaican, Haitian, Bahamian Treasury note swap. So most remittances from this country go to Jamaica and Haiti. Probably about $100 million a year, thereabouts. So how would this work? Well, the Bahamian Central Bank would hold Jamaican Treasury bills and notes, and Jamaican Central Bank would hold Bahamian Treasury bills and notes. So I'm a Jamaican now. I go to a money transfer company with $100 Bahamian. Now, that money goes through the money transfer company bank into the central bank, and the central bank will then debit their account of Jamaican Treasury bills and bonds, the equivalent in Jamaican dollars, just using the US dollar as a reference point. And they send that down to, they get to Jamaica to debit, they credit the account in Jamaica, and they pay it out to the bank in Jamaica, who pays it out to the person who's receiving the monies. And then the reverse occurs with money coming from Jamaica into the Bahamas. So you don't touch any US corresponding bank, you're just using the US dollar as a reference point. Of course, this means more work for the central bank, right? But it could work. Now, let's talk about the Renminbi Yuan Bahamian dollar swap. Nào chưa? Ni minh bài mà? Hèn hào. Okay. Now, how does it work? The People's Bank of China, which is their central bank, would give the Bahamas, let's say, $100 million in renminbi or yuan, which is Chinese currency. And the Bahamian Central Bank would give the Chinese Central Bank equivalent in Bahamian dollars. Okay? Now, oil, as I said to you before, is one of our biggest imports, drain on our US reserves. Okay? So now we take that $100 million, or part of it there, for example, and we buy, when you get 10 minutes left? Give or take. All right. We buy $100 million worth of oil from Venezuela, who will accept the Chinese currency, and then they take that money to Shanghai and get gold on the Shanghai exchange in exchange for the yuan. Now the Chinese still have $100 million worth of our currency, so they would then buy Bahamian assets, real estate, invest in businesses like Brian's business, right? Or, which we want to do, develop our agricultural sector. So now we don't have to buy import as much stuff, right? And the excess will go to China, who needs food. Perfect deal. All right, so Rick says I got to hurry up, and I don't know why he's rushing me, because I just getting started, but anyway. So let's look at something a little bit global now. We'll go away from the Bahamas, go to the outside world. In the United States, as you know, after the Great Recession, the Federal Reserve printed a lot of money to get the economy going. But now they're trying to reverse that. So they're now tightening, they're increasing interest rates. So that means the value of the stocks is going to go down, real estate is going to go down. It means that the economy may slow down. It means the government's going to receive more money in taxes. And it also means that those countries who borrowed in US may have a problem. These guys right here, okay? That's the problem. So countries around the world have used dollars for many years. It's been the currency for trade, the currency for commodities, the reserve currency of banks. But they're getting scared because the US is in bad shape. They get $14 trillion in fiscal deficit, debt to GDP total over 175%. It's a mathematical impossibility for them to grow out of their debt. Can't do it. Impossibility. Only got two choices. Print money, inflate the way out of debt, or default. They're not going to default because the banks will go under. So they're going to print it. All right? So realizing this, all the developed countries, the IMF included, all right, the World Bank, are all accumulating gold like crazy. All right? So, because when they start to inflate, the value of gold is going to go up. Except the Central Bank of the Bahamas. We don't have 1 ounce of gold. Okay? Pardon me? No gold in the central bank, no. So China and Turkey, Iran, Russia, their gold reserves have gone up by 3 to 4-fold in the last 10 years. China stopped buying US Treasury bills and bonds in 2016. Russia stopped buying them last year. Okay, now the geopolitical reasons as well. When you disobey these boys, the big four, they cut you off from the payment system, right? So the Chinese and the Russians, the Koreans, they say, screw it. We're going to have our own payment system. So what they have now is they use their gold and they have a cryptocurrency and a distributed ledger, and they distribute monies around themselves using this gold-based cryptocurrency. At the end of the day, they net out by flying gold from whichever place ends up with the net receiver of gold. Okay? That's called the axis of gold. Also, China is saying, we buy more oil than anybody else in the world. Why should we have to pay for it in US dollars? We want to use our own currency, and I agree with them. So now they have a deal with Venezuela, Iran, and Russia to buy oil from them using Chinese currency. And they convert it to gold on the Shanghai Exchange. And the Chinese are buying a lot of gold. They don't want the price to go up. The price would go up if everybody keeps buying in exchange, but they use the futures market to sell gold to keep the price down. The Chinese are the smartest economists in the world. Okay, so implications of the Bahamas. If there's a US recession, we go into recession. Emerging market sovereign debt crisis, financial crisis, we got a problem. US inflation, we got inflation. And the central bank needs to start buying gold. So do all of you. Now let's talk a bit about this to finish off with. I say this to last because I know Rick might be interested in this. He's kind of old for this, but anyway. So what's the difference between a digital currency or fiat currency and a cryptocurrency, right? Well, what's money? It's a unit of value, it's a medium exchange, and it's a store of value, okay? So cryptocurrency could be a unit of value. Now, is it a medium of exchange? Limited, only some places accept it, right? Is it a store of value? Well, we saw what happened to Bitcoin, right? Okay, so think about it in that light. But when you talk about cryptocurrency, there's no such thing as cryptocurrency per se. You have to think about each individual coin. And Brian can tell you about all the different coins, Madero, Litecoin, Bitcoin, whatever. He knows all about those different coins. But the only difference really between one coin and another are really the protocols or the way they are validated on the distributed ledgers or the blockchain, right? So you have to understand that. And each coin is different. Each coin has its own distributed ledger, its own blockchain. All right, so you have to understand all that. You got to read the white papers, understand the proof of work, proof of scope, proof of this, proof of that. You go crazy trying to understand all that. That's why you ask a guy like him and he explain it to you. So it's supposed to be trustless. Okay, they're not depending on the central bank, the banks, the stock exchange, nobody. Whereas the fiat system is trusted. You have to have permission to go on the fiat digital system, which is a digital system. It's just it's centralized, it's not distributed, right? On the blockchain, you don't have to have permission. But the advantage of fiat over the blockchain is that rapidity. You can do more transactions very quickly. The blockchain is still kind of clunky. The fiat is inflationary. The blockchain is deflationary because you can't keep printing money using cryptocurrency, whereas every time you get a loan from the bank, that's inflationary. The only reason why we haven't had inflation is because of the deflationary factors happening right now, debt, deleveraging, technology, and demographics, which is stopping inflation from occurring in the world right now. So the other difference is you can't have credit with a cryptocurrency. And in any economy, any monetary system, you have to have credit. You have to be able to borrow. But if you borrow it in a deflationary currency, then what happens is the value of what you borrowed 2-3 years from now will be higher than it was when you borrowed it. That's the limit, okay? Tremendous volatility, lower volatility with fiat. Utility, I mentioned before, both are hackable. All of them are hackable. Now, I don't think anybody's ever been hacked on the blockchain itself, but they hack you at the level of the exchange. Low energy versus high energy. We all know about that. Right now, cryptocurrencies, Bitcoin is using the entire amount of power is being used in Ireland. In a few years' time, it'll be the entire amount of power being used in Japan, which is the third largest economy in the world. Government's not going to allow that to happen. Zero-line painting with digital, but you get it with crypto. What I mean by that? The guys who own most of the blockchain, to keep the price up, they'll sell to you, you sell back to me, I sell back to you, you sell back to me, the price goes up, the other suckers are looking, they say, oh, but the price is going up, we better buy. They buy, then they sell, and they get left holding the bag, right? Okay. A lot of criminal activity, okay, whereas this is not quite so much. Tested in a crisis, whereas crypto is not. You think that the monetary elites, the IMF people and the BIS, are going to let a bunch of computer geeks take over the money supply? It won't happen. They're working on their own crypto right now, right? And that's why the central bank is doing the same. They got orders from the IMF. This is what you got to do, Jack. Okay. So there's going to be national digital currencies in a fairly short time, and a few crypto survivors. And eventually it's going to be a world currency, which will probably be the SDR backed by gold, and I'm not sure what's going to happen here. So if you wanted to create the ideal crypto, and I got this from Jim Rickards, who's a monetary economist, you want something that you don't have to have a minus. It's done by consensus, like Google, like a Google search. Open source, so you have access to the code. It's impenetrable, meaning that if the Russians want to take over the blockchain for Bitcoin, right, they could put in all the money, claim they have 51% of the Bitcoin, and you lose your Bitcoin. All right? And you have a more efficient system where you have to go through all that proof of work and all that other stuff. And it's got to be nimble. It's got to be equal to Visa, MasterCard, PayPal. Okay? That would be the perfect cryptocurrency. Now, we need to have, so just, I'm going to finish right now, Rick. Take-home points. New laws. Truth in lending laws. Antitrust laws. We need to have a consensus-guided monetary policy. At the central bank, you have one or two individuals who make that call that affects everybody else. But we need to help to determine what happens to us in the economy. Not just one person or two people. That's madness. We need to have an increase in US dollars. We've already been through that. Buy gold, sell dollars, especially the Bahamian dollar. And monetary elites, you either join them or you bypass them. So I want you all to try and get jobs at the BIS where you don't pay any taxes, immune to the law, diplomatic immunity, right? Or you bypass them by using the types of arrangements I talked about, like the swaps. Okay, thank you very much.